Before you skip this video, listen carefully. What you're about to hear will not sound like normal gold news, because this is not about price charts, targets, or predictions. This is about why gold is behaving differently, and why most people will realize it too late. Right now, millions of investors believe gold lost momentum at the end of 2025. They believe the move is over. They believe the danger has passed. That belief is exactly why gold is becoming dangerous to ignore. As 2025 ended, gold didn't collapse. It didn't break down. It paused. And pauses in gold are never random. Gold pauses when the system is adjusting behind the scenes. What most people saw was weakness. What institutions saw was confirmation. Because gold does not move on optimism. Gold moves on stress. And stress has not disappeared. It has gone quiet. Here's what changed, and this is critical. For the first time in years, gold stopped reacting to headlines. No excitement, no panic, just controlled volatility. That tells you something powerful. It tells you the buyers are no longer emotional. They are structural. Central banks were not buying gold because inflation was high. They were buying because trust was falling, and trust is the one thing you cannot fix with interest rates. The Federal Reserve didn't even need to cut rates yet. Just the expectation of rate cuts was enough to weaken real returns, enough to expose the debt math, enough to remind capital that cash is not neutral anymore. When real yields turn negative in disguise, money looks for an exit that doesn't require permission. That's where gold comes in. While retail traders were arguing on social media, central banks were quietly absorbing supply. China didn't stop. India didn't slow down. Emerging markets accelerated. And here's the part most people miss. Central banks don't care about price. They care about availability. They are not trading gold. They are removing it from the system. Every ounce that disappears into reserves is one less ounce protecting the paper system. That's why every dip gets bought. Fast, aggressively, without hesitation. Margin hikes flushed out weak hands, and stronger hands replaced them immediately. That is not distribution. That is transfer of ownership. And ownership is shifting from leveraged speculation to long-term control. Now let me ask you something. If gold was truly topping, why would institutions keep buying weakness? Because they are not preparing for growth. They are preparing for adjustment. Adjustment in currencies, adjustment in trade, adjustment in power. Look around the world. Sanctions are no longer temporary. Trade routes are under pressure. Energy supply is politicized. Payment systems are being weaponized. In that environment, gold is not an investment. It is insurance against fragmentation. Gold doesn't default. It doesn't freeze. It doesn't need a clearinghouse. And that is why volatility is rising. Not because gold is unstable, but because the system around it is. This is where people get confused. They see sharp corrections and think the move is over. But corrections in gold during stress cycles are not exits. They are stress tests. They exist to shake confidence, to reduce leverage, to force impatient money out. What remains after that is sticky capital. And sticky capital does not sell easily. This is why the most dangerous position right now is not being wrong on price. It is being overconfident in stability. Analysts keep asking, can gold really go that high? That is the wrong question. The real question is, what would stop it? Positive real yields? Not happening. Fiscal discipline? Gone. Geopolitical calm? Fading. Currency trust? Weakening. For gold to reverse meaningfully, all of those would need to improve at the same time. They are not. Instead, deficits are expanding. Political pressure is increasing. Central banks are trapped by their own balance sheets. Gold doesn't need panic from here. It only needs continuity. Continuity of bad decisions. Continuity of debt growth. Continuity of short-term fixes. This is why gold is not shouting yet. It is speaking quietly. And history shows something uncomfortable. When gold speaks softly, it is because the system is still pretending. When gold starts screaming, it is already too late. What we are seeing now is not the end of a cycle. It is the calm before the public understands what institutions already do. Gold is not predicting prosperity. It is pricing adjustment. And adjustments are never comfortable. As we move deeper into 2026, gold will stop asking for attention. It will demand it. And when that happens, the people waiting for confirmation will realize something painful. The move didn't start when gold broke records. It started when trust broke quietly. Gold just noticed first.